before, you enter in your trade somewhere here, and you put your stop loss just below the swing low, and what happens? Well, the moment you place the trade, the market starts going towards your stop loss, just like a maniac, hits your stop loss, and then it starts rallying to your take profit. Now, if this happens to you over and over and over again, then this video is going to be very important to you, because this video will show you what you're doing wrongly or whether your brokerage is against you. So this will help you reduce a lot of losses. Okay, so my purpose for today's video is not so much to maximize your gain, but rather to minimize your loss. So this is what I'll be covering today. Okay, I'll start this video by talking about whether is the brokerage really against you? Of course, I cannot talk about every single brokerage. I will just talk a generic, meaning that generally, how does a brokerage work? Okay, I want to give you some insights that we have from working closely with a brokerage. As you already know, we have a lot of deals. Okay, in fact, we have a deal with markets.com right now. We have a bonus for you. The link can be found in the description. Basically, we work very closely with brokerages, and because of our close working relations, we're able to get some insights that the average retail traders like you will not get. So we want to share that with you. The next thing that I want to cover is how do you tell if a brokerage is deliberately stopping you out? Okay, there are telltale signs about whether the brokerage is doing this just to eat you alive. So this is the portion that you really want to pay attention to if this scenario keeps happening to you. Now, I want to end off this video by showing you how to set your stop loss correctly. Okay, if you are trading with a brokerage that is deliberately stopping you out, the best solution for you is not to trade with that brokerage. But if you really insist on trading with that brokerage, then I think the least I could do for you is to teach you how to set your stop loss correctly, so that hopefully the brokerage will not stop you out and profit from your loss. Okay, so let's get into today's video. But first, please give us a thumbs up, right? Really appreciate if you just take 3 seconds of your time. Okay, hit the subscribe button, turn on the notification bell, because we create a lot of videos like this to serve you. Okay, we also have a free day trading guide. So if you have not already downloaded it, make sure you download it, because there's a lot of good materials inside for you. So let's talk about the first question. Is the brokerage really against you? Now, the answer, which you're not going to like, is generally speaking, it's no. Okay, why is it no? Now, it is generally not worth it for them to try to take you out. Right, most retail traders like you and I, you're probably trading a small account. You're trading probably a $500 account, $5,000, even $20,000 account. It's a very small amount. It's not like the institutional traders who are trading 10 million, 50 million. So it is just not worth it for them to try to take you out. Because you should know that the Forex market is one of the most liquid market out there. So what does it mean when it's most liquid? It means that it's very hard for the brokers to move price in a singular direction. Okay, this is not taking into account all the algorithms out there which trade high frequency and trade really fast. So generally speaking, it's very difficult for them to move prices to your level to take you out. And it's not worth it as well, because if you have just $1,000 and you just take, let's say, 1 standard lot, 2 standard lot, it's nothing to them. Okay, in the grand scheme of things, $2,000 is nothing. So that's the general answer. And generally, brokerages have 2 kinds of business model. Okay, this is something that very few retail traders know. So if you do not know how the brokerage business works, this is an insight as to how they work. So generally speaking, they have 2 kinds of business model. They call it A book and the B book. So in the A book, how they earn is they are just executing your orders. So basically, when you take a trade, they just push your trade out to their liquidity providers and they actually execute your trade. So the only way they earn is actually through commissions, through the swap, through the spread. So this is very good for the brokerage because it gives that long-term recurring revenue, especially if the trader's account is, equities keep making an equity high like this. That means that over time they trade bigger, and that means more commission from for the brokerage. So if I'm a broker, this is the kind of business I like to do. I like to do this because long-term wise, I will make more money. Just imagine if someone drew a $100,000 account to a $5 million account, his trading size is going to add up each week. He's going to trade bigger, and my revenue is going to increase alongside with his equity curve. So that is the first model. The second model is the B-book model, which is the model that a lot of you are familiar with. It's the churn and burn model, where they don't actually execute your trades. They just take the opposite end of your trade. So let's say you were to be buying. Okay, let's say you buy. They are essentially just selling. So they take the opposite end of your trade. Just think of it like soccer bookie. If you bet Arsenal win, they bet that Arsenal will lose. They just take the opposite end. So of course, if you lose, that means they win. And that's where things get very tricky, because that's where certain brokerages get very greedy, and they want to stop you out, because when you get stopped out, that is when they profit. Okay, so this is also the business model where a lot of people get hurt because they put money into brokerages which they widen the spread, or they deliberately move the charts, the price feed, so that you get stopped out. So while most brokerages operate mainly on this one, okay, because most of the time, 95% of traders lose money. So it's very hard for them to A-book, because most people lose money. So it's better for the brokerage to do a B-book, even though the A-book in the long run will make them more money. Most brokerages still do B-book because 95% of traders lose money, which means that the probability of them making money by betting against you, it's 95%. Now, the other thing you need to know is that A-book also requires margin. So for them to execute your trades, they also need to come out a certain degree of margin. And that's why a lot of brokerage don't like it, because they need to come out capital at the same time. There are certain regulations that dictate how much margin they need to put out. Now, with this being said, it doesn't mean that all brokerages are deliberately stopping you out. In fact, I would go as far as to say that most of the time, traders set their stop loss wrongly. It's not that the brokerage is trying to stop you out. Okay, as I mentioned earlier on, it's not worth it for them. Okay, I've written over here, it's not worth it for them to do it. But most of the time, traders set it wrongly, and then they say that the brokerage is out to get them. So towards the end of this video, I want to show you how do you actually set your stop loss correctly, so that you will not have this problem. Now, I want to move on to how do you tell if a brokerage is deliberately stopping you out. Sorry for the typo over here. Okay, so how do you tell? It's very simple. You want to look at the spreads. Look at the spreads during the news event, okay? For example, like NFP, unemployment rate, and you want to compare these spreads with other brokers. Last time when I just started, I think in my first or second year of trading, I opened an account with this brokerage, and during the NFP, the spread was as high as 15 pips. So other brokerage during NFP, they are probably doing 3 pips, 2 pips, 3 pips for euro dollar. Okay, 2 pips. But this brokerage was doing 10 pips, 12 pips. So that's a sign that this brokerage just wants to stop you out, because when they stop you out, as I mentioned, when you lose money, that's when they make money. So this is a telltale sign that the brokerage is trying to stop you out, and you should avoid trading such brokerage. Again, if your brokerage is currently doing that to you currently, right, we do have a link with our brokerage, markets.com. The link's in the description. We have a bonus for you, right? You don't have to use our link. This is not a sales pitch. Okay, but if your brokerage is currently doing that to you, markets.com will not do that to you. So you can check the link in the description. We throw in some additional bonus to sweeten the deal just for you. Now, let's say you are trading with your brokerage and they widen the spread and you do get stopped out. How do you tell whether this is a deliberate attempt? What you can do is that you can insist to look at the order report. Now, the order report is kind of like an document or a report that shows the liquidity of the currency pair at that time. So by looking at the report, you can tell if their liquidity provider had the kind of like the order at that price or not. If they are unable to give you this order report and be transparent with you, that is another telltale sign that the brokerage is a shady brokerage, and it's also a sign that you shouldn't be trading with them. Because if, let's say you are trading with a legit broker and they can show you the order report and it is true that you got stop out at that price, then honestly, there's nothing that you can do because they have an official record that say that, okay, at this point in time, the liquidity, it was this, therefore there was a slippage and therefore we had to stop you out. If they can back their, the slippage with an order report, then that is fine. But if they can't do it, then that is also a sign that this isn't a good brokerage, and it's a sign that you shouldn't be trading with this brokerage. So let's go on and talk about how to set your stop loss correctly. Okay, so hopefully you trade with a good brokerage. That's the best case. But if you know you are stubborn or you're just lazy, the next best alternative is to set your stop loss correctly. So how do you set your stop loss? You want to set using the average true range indicator, ATR default setting as 14 days. I will go into the charts shortly to show you how to set it up and how to use it. But here's the rationale why you want to set an ATR of 14 days. Now, setting a stop loss of 1 time ATR should be safe enough, because if, let's say you are wrong, price, or rather, let's say if you are right, price should not trade against you for 1 entire day's range. So what does ATR means? It means what is the average range of the currency pair across 14 days. So if, let's say you entered and the ATR is 100 pips, it means that the previous 14 days, the entire range of the day is 100 pips. Now, if you time your entry correctly, price should not trade against you the entire day, which is 100 pips in this case. So if price trades against you 100 pips, it is almost certain that you are wrong. You timed the market wrongly, there's something that you did wrongly. So this is quite a foolproof way to set your stop loss. So let's go into the charts right now, because I want to show you how do you do it. So right now I'm at tradingview.com. So it's very simple. Just click on over here, indicators, and just type the average true range. So average true range, you can see over here. So in this case, I already have it set up. So I'll just leave this on. Okay, you can see that this is the 14. I will just leave the setting as a 14. Length 14 means 14 days or 14 candles. And the smoothing is actually the moving average. Just leave it as the EMA, which is the exponential moving average. Click OK. Now remember to use this on the day chart, okay, because you want to look at the 14 days. You don't want to use it on the H4 or H1, because that would mean the past 14 candles. It's not as significant as 14 days. So let's say you want to enter right now. Let's say you want to sell, and right now the ATR is 0.00765. That means about 76 pips. So what you can do, let's say that you want to sell, you just put it here, and you just set it as a 76 pips. Okay, something like this. Let's say you sell at the current price, and you just put a stop loss of about 76 pips. Something like this, okay? So that's how you use the ATR to set your stop loss correctly. Now, I have a lot of other videos about the ATR. I will leave the link in the top right for you to check out, just in case you need more understanding on how to use in this indicator. But in this video, I just want to talk about the Forex brokers, whether they are stopping you out and how to set your stop loss correctly. So here's a recap. I started this video talking about whether the brokerage is really against you. In most cases, they are not against you. Okay, it's just that you are setting your stop loss wrongly. Okay, but in cases where the brokerage is against you and deliberately stopping you out, I also went into details on how you can tell whether the brokerage is doing that to you. Basically, you want to look at the spread during the news event, and you also want to look at the order report when you get stopped out. Then lastly, I went through how do you set your stop loss correctly. Basically, you want to use the 14-day average true range to help you set your stop loss. Okay, so I hope this video has been helpful. As always, if you have a question, any issues about your brokerage, any other issues about any other concepts, just leave a comment down below. We love to help you. Right, make sure you give us a thumbs up. We really appreciate it. Okay, hit the subscribe button, turn on the notification bell so that you will not miss another video from us. If not, thanks for watching. I'll see you in the next video.